Hi, I'm Pattu from FreeFinCal, and in this video, let's talk about what happens if your bank goes bust and is not able to repay your deposit. Many of you must have heard of the 1 lakh insurance limit available for your accounts and deposits. But how does it work? Does this insurance mean that you will get your money back immediately? Who ensures that your money is given back, and so on? So let's talk about deposit insurance and the features of that. So, if you look at this article that was published today at FreeFinCal, and there's a link to a LiveMint post that was written after the PNB Nirav Modi scam. So, bank scams have been happening on a regular basis in history. It's not something new, or it's not something that happens once in a while. Between 1935 and 1947, it says 900 banks failed, and 665 banks between 1947 to the nationalization of banks in 1969. So as always, regulation follows a scam, and the Deposit Insurance and Credit Guarantee Corporation was instituted after the around 1949, and it essentially there's an act that came into place, the Credit Guarantee Act, and is now the corporation is now a wholly owned subsidiary of the RBI. Now how does this work? So now, before we get to that, I want to show you this study by the World Bank. This is essentially a database maintained by the World Bank. And if you notice in page 21, I'll link this below. If you see here, that is the country name and the year in which the deposit insurance came into place. If you notice, the United States has the oldest deposit insurance at 1934, and followed by that, India is the second oldest. Many other countries, they had deposit insurance in place only decades later. We make a lot of hue and cry about the corruption in the country and so on, but the government is doing its work in providing some sort of help to people. But of course, having a deposit insurance does not mean that it's an immediate repayment. So you should not criticize everything that we see around our country. That's my point. And also, when we talk about deposit insurance, when we talk about insurance per se, people immediately assume, okay, if something fails, immediately I'll be paid money. That immediate does not apply to deposit insurance for sure. And that's the reason why I'm making this video. So how does this work? So this deposit insurance covers your savings banks, current accounts, fixed deposits, and recurring deposits. And it also covers deposits from all commercialized banks, local area banks, regional banks, small finance banks, payments banks, and all cooperative banks. We'll talk about small finance banks in a separate video. So let's see how this works. Let's take some examples. So the first thing is that, let us say I have an account in some bank. I have a SB account there, I have a recurring deposit account, and I have a fixed deposit account. I am the only holder. So if the bank fails, then the sum of my current balance in SB account plus the FD plus the recurring deposit will be added. And if it is less than 1 lakh, I will get that money. If it is more than 1 lakh, I'll get 1 lakh. That's all. So this 1 lakh is the sum of, it is principal plus interest. It's not principal separately and interest separately. So for example, if I have a 1 lakh giving an interest of 7,000, the amount insured is only 1 lakh. And if I have a deposit of 95,000 giving an interest of 5,000, then the amount insured is 1 lakh. The sum, it's the sum. So it's not separately, it just whatever it is, the total up to 1 lakh will be covered. And also, if I have an account in, let's say, a branch in one part of the city and another branch in other part of the city or other part of the country, that doesn't matter. The sum of all these accounts should be taken together, and a maximum of 1 lakh will be insured. So you cannot claim 1 lakh for insurance for this account, this branch, and 1 lakh for that branch, and so on. Of course, there are some advantages. If I have an account in one branch where I am the first holder and my wife is the second holder, and in another branch my wife is the first holder and I am the second holder, those two accounts are considered separate, and you will have a separate 1 lakh limit for that, and that's pretty nice. Also, You can also have a situation where, let's say, I am the first holder in an account, and my wife is the second holder, and I have another account in which I am the first holder and my son is the second holder. Again, those two accounts are considered separately, and the 1 lakh will apply separately for both accounts. So that works quite well. Also, you can have a situation where I have an account where I am the first holder, there's no other holder, I'm the sole holder, and I have another account where I'm the first holder and my wife is the second holder. Again, those two are considered as different. Also, if I'm the guardian of my for my son in another account, that's considered separate. And also, if I have a company and I have a company account, that's considered separate. If I run a trust and I'm named as the caretaker of that trust in the account, that's considered separate. So there are many ways, there are many advantages to this. You can't call them loopholes, but these are features that can be used to increase the overall cumulative deposit insurance amount. So how does this deposit insurance work? So the first thing is that there can either be liquidation or it can be merged or acquired by another bank. So there are two ways. So if there is a liquidation, which means that the bank is essentially winding up and it's closing out its business, there will be a liquidator appointed, and that liquidator will be responsible for managing the assets of the bank and close it up. So they will have to get the money from the Deposit Insurance Corporation, and then the liquidator will pay it to the depositors. Right? So the liquidator will prepare a list. I'll show you problems here. They will prepare a list and send it to the Deposit Insurance Corporation for scrutiny and payment. Then the Deposit Insurance Corporation will send it to the liquidator and then pay it to the depositors. Of course, the KYC has to be complete and it has to be updated, otherwise there will be problems and so on. Now the point is, just like all other regulators, you cannot just directly apply to the deposit insurance. So you will have to go via the liquidator and so on. There is in the case of amalgamation, it's a little different. I don't want to explain everything. I don't want to read out the post. You can go look at it. The reason I'm making this is because I didn't do it in the. I did not show you screenshots in the article. Now there's really no problem because the Deposit Insurance Corporation does have enough money. Otherwise, if it doesn't have enough money, it can borrow from RBI. But those are all quite extreme scenarios. You don't need to worry about it. It has been making claims regularly, and there's no issues about it. There's a link which here in the article which tells you about the claim settled. That is not the reason I'm focusing on. I don't care about that. Look at this. Can claim settlement be delayed? Oh my God! Have a look at this. So this is the Deposit Insurance Corporation page. You can access it via the link in the article. There is a claim submission pending list, and if you look at this is the date of deregistration of the bank, and that's like 2 years ago. The claim list is still under preparation. How long will it make to make a claim list? You please have a look at that. You please tell me. This is 1999, still not being paid. 2018, okay, relatively better. 2016, 2017, look at that, 2010. There are many reasons here, and so it's there could be issues in court, and there are other inquiries going on and so on. So that's the primary thing. If you just because you see a fixed deposit being offered for 9% or 10% by a small finance bank or some kind of cooperative bank, and you cannot just go and say, okay, I have 5 lakhs, I will put 1 lakh in my name, then 1 lakh in another joint account with my wife, and then I have another 1 lakh in joint account with my wife where the first holder is swap, 1 lakh with my son, and so on. Just because I have deposit insurance of 1 lakh or up to 1 lakh, I cannot say all my 5 lakh is insured. That's not the point. That's not how this whole thing works. Please recognize, if the bank fails, the deposit insurance is available, but it is not available immediately. It could take months and years, some decades in some cases, for you to get that money. So what is the point? If that money is practically as good as lost. Please recognize, time is money. You got greedy and started investing, went into this investment only for that return. Please recognize, The more that return gets delayed, the more it gets lowered. So the point is lost. So you're taking a huge concentrated credit risk by going after these high interest rate FDs. Please be careful. You do not need to pay a premium for this deposit insurance. The bank will do it. It's a very small amount, as seen there. It's just 0.1% of the eligible deposits, but it's their problem. They will have to compulsorily take this deposit. So this is I've just answered this. Should you invest in FDs of small finance bank? We will talk about this in a detailed video. Many aspects to consider about this. You can do that, but please be careful. If it fails, that's it. So please don't put too much money into this. You're going to put. So that's the logic I always give to people. Anyway, you don't have the courage, or you are not going to take a risk of putting all your money in small finance. You're only going to have a small exposure. If that, how much great wealth is that small exposure going to build you? Nothing. All you're going to do is lose sleep and waste time doing paperwork if the bank fails. Why are you running after it? So please don't do it. So if you say, on the other hand, if you are worried about such risks, then stick to domestic systematically important bank, or DSIBs. So these are banks which are considered too big to fail, and the government will bail them out. So RBI has now said that in addition to State Bank of India and ICICI, HDFC is also a domestic every time I see systematic, I thought systemically important banks, DSIBs. And so these are, well, to make it simple, it means they're too big to fail. The government will somehow keep them alive, so you don't have to worry about money relatively. Another point made in Asan Ideas of Wealth is you can invest your money in post offices where you have a sovereign guarantee. So that's if you're so worried about this, either you stick to post offices and suffer through their bad service and the lack of online facilities, or you stick to big banks like this. Then you don't have to worry, because the government will ensure that it doesn't fail. Even if it fails, it will somehow manage. There have been situations like this before. So that's what I wanted to talk about. Deposit insurance. It's available, but it's more. Think of it more as a theoretical safety net. Right? It will, because of the time involved and the paperwork involved and the emotions that will go through if your bank fails. So don't chase after returns in fixed deposits, because you're taking concentrated risk. That is why I personally like to suggest chasing after returns in debt mutual funds, because the credit risk is diluted, because it's just 1% fall or maximum 2% fall if you take a huge mutual fund. Of course, there are funds which will buy 10% of bad bonds. That's a problem. But even then, it's only 10% relatively. So it's not. You have to recognize what you're doing. There is no extra return without extra risk. This is something that so many people fail to recognize. So please recognize this. We'll talk about small finance banks now the video. Thank you for watching. I'll catch you later. Bye-bye.